The 2008 financial crisis wasn't just a market crash. It was the moment the world woke up and realized that the financial system we all trusted was far more fragile than anyone believed, but it didn't just crumble overnight. No, this collapse was built on years of risky decisions, blind optimism, and financial inventions that looked brilliant on the surface but were hiding a dangerous secret. When it all finally came crashing down, millions of families paid the ultimate price, while many of the architects of the crisis walked away with bonuses. That deep imbalance is what makes this story so critical to understand today. To see how it all went wrong, we have to go back to the early 2000s. The housing market had become the engine of the American economy. Home prices were soaring, and buying a house felt like the safest, smartest financial move you could possibly make. Wall Street saw this boom and thought, how can we turn this into a product? And so, the mortgage-backed security was born. The idea was marketed as simple. Banks would take thousands of home loans, bundle them together, and sell them to investors as a single, stable investment. The promise was safety, steady returns, and security, all backed by physical homes all across the country. But the hunger for these products grew much faster than the supply of safe, qualified home buyers. Instead of tapping the brakes, lenders just threw out the rulebook. They started approving incredibly risky loans to people with shaky incomes, poor credit, and sometimes no paperwork at all. These were called subprime mortgages, and they were mixed right into the same bundles as the safer loans. On paper, it looked like a balanced portfolio. In reality, it was a house of cards. And behind the scenes, another layer of high-stakes betting was taking shape. Investors began using something called credit, default swaps to place massive bets on whether these mortgage bundles would succeed or fail. Think about that. Some people were literally making money when ordinary homeowners started to struggle. And what about the watchdogs? The rating agencies, whose entire job was to warn investors about risk, were stamping these toxic products with their highest safety ratings like a AAA. Why? Because they were being paid by the very same institutions that were creating the products. It was a massive conflict of interest that kept the whole machine running, full steam ahead, without any critical oversight. By the mid-2000s, the warning signs were flashing everywhere. Home prices were completely disconnected from wages. Houses were being flipped for a profit before anyone even moved in. Entire neighborhoods were being built without any real, long-term demand. It looked like explosive growth, but it was actually a bubble, quietly stretching to its breaking point. Then the first cracks appeared. Interest rates on all those adjustable mortgages started to climb. Suddenly, homeowners couldn't afford their new, higher payments. Defaults began to rise. Foreclosures spread like a virus. And the value of those once celebrated mortgage-backed investments began to plummet. The entire financial system, which had been built so heavily on these loans, started to shake violently. In 2008, the cracks didn't just spread, they shattered the foundation. Bear Stearns collapsed. Then Lehman Brothers failed in the biggest bankruptcy in U.S. history. AIG, one of the world's largest insurance companies, was teetering on the edge of oblivion. These weren't just small players. They were pillars of the global financial system, and their fall sent shockwaves across the entire planet. Credit froze. Markets plunged. Businesses closed their doors and millions of jobs simply vanished. Families lost their homes, their life savings, and their retirement plans. In the United States alone, household wealth fell by more than $19 trillion. Governments were forced to step in with historic emergency measures. Trillions of dollars were deployed, not to help struggling households directly, but to stabilize the financial system itself. The biggest banks were rescued to prevent a complete and total collapse. And while that intervention may have prevented an even deeper catastrophe, it created a painful, bitter divide. While ordinary families were struggling with unemployment and foreclosure, some of the very institutions that caused the crisis recovered quickly, and in some cases, even rewarded their executives. In the years that followed, central banks around the world tried to restart the economy with aggressive policies. They pushed interest rates down to almost zero and printed new money to buy financial assets. It worked, in a way. The markets recovered. Housing prices started to climb again. Corporate profits soared. But for most people, things felt different. Wage growth stayed flat, and the gap between the wealthy and everyone else widened dramatically. Then, when the pandemic hit in 2020, governments responded with even larger, more unprecedented stimulus programs. For a brief moment, It felt like modern finance had finally found a magic formula to escape any deep recession. But the consequences of printing all that money arrived quickly. Inflation surged to levels not seen in decades. Borrowing costs began to rise. And the same vulnerabilities that caused so much trouble back in 2008 started to reappear, just in new forms. Today, the system is bigger, faster, and more complex than ever before. Debt levels are higher across the board for households, for businesses, and for governments. Financial products are more sophisticated, but that doesn't mean they're any safer. In many ways, the basic architecture looks eerily similar to what existed right before the 2008 crash. Only now it's more interconnected and much harder to control. So, what can we really learn from all of this? The first lesson is that complexity is often used to hide risk. When an investment becomes too difficult for anyone to truly understand, it's often because it carries hidden dangers that people haven't noticed yet. The second lesson is that incentives drive behavior. If big institutions expect to be rescued every time they make a reckless bet, they're going to keep taking even bigger risks. And the third, most important lesson is that financial education is no longer optional. Understanding how money, debt, and markets actually work is a fundamental form of self-protection in the modern world. Every boom eventually slows. Every bubble eventually bursts. The 2008 crisis wasn't some random, once-in-a-lifetime event. It was a warning, a glimpse into just how fragile our system can become when oversight, incentives, and basic responsibility fall out of balance. Preparing yourself means learning how this system actually functions and making smart decisions that keep you stable, even when the world becomes uncertain, because real wealth isn't just about money. It's about understanding, clarity, and resilience. If this helped you see the bigger picture, hit that subscribe button. At Legacy of Money, we uncover how the modern financial world is built so you can navigate it with confidence. Thanks for watching.